Welcome back to the deep dive. This is where we take your sources, we break them down, and really try to pull out the essential models you need.
That's the goal. And today we're tackling a really interesting comparison, I think. It's about investment.
Yeah, high stakes stuff. We're looking at sort of the wild world of crypto volatility versus businesses that just make tons of cash. Cold, hard cash flow.
Right. We're stepping back from just, this went up 10x.
Yeah.
We're digging into the actual structure of these investments based on the source material we've got.
And the sources pit Bitcoin and crypto against two very specific, very large companies known for cash generation, Alphabet and Airbnb.
But first, we kind of have to acknowledge the elephant in the room, don't we?
Absolutely. You have to be straight about it. Looking back, say, the last 10 years, Bitcoin, phenomenal performance.
Oh, undeniably. The sources are clear on this life-changing returns for some people. People who could stomach the ride anyway.
You just can't wave that away. The returns were real.
No, you can't. But, what worked yesterday doesn't always work tomorrow. And that leads us straight into the main point from our sources, the real core difference they highlight.
Like aha moment, yeah.
Kind of. It's the key thing that splits these two apart, fundamentally.
And it's actually pretty simple when you boil it down. Cryptocurrencies just don't generate cash flow, period.
Right. The sources basically frame them as gambles. Your hope for profit relies completely on someone else coming along later and paying more than you did. Speculation.
Pure price movement based on
What?
what? Sentiment, hype, liquidity flows.
Pretty much. I mean, think about it. When you buy a token, it doesn't. It doesn't make anything. It doesn't sell a service in the traditional sense or have subscribers paying fees that flow back to you, the owner.
Its utility might be something else entirely, like a payment network or something, but not profit generation for the holder.
Exactly. The utility isn't directly tied to generating tangible income streams for the asset holder in the way a company's profits are.
Okay, so if that's the, let's call it the foundational flaw on the crypto side, according to these sources, what's the strength on the stock side?
The anchor. It's all about the anchor. When you buy, say, a share of Alphabet or Airbnb, you're buying a piece of an actual operating business.
A business that takes in revenue, pays its bills, and hopefully has money left over.
Lots of money left over in these cases. That's the annual cash flow. It's quantifiable. It's generated by the business itself. It's real.
And that difference, cash flow versus no cash flow, is what the sources argue makes stocks ultimately less risky and potentially better long-term bets.
That's the core argument. It's about having that financial bedrock versus floating purely on market sentiment.
Makes sense. So, okay, let's put the abstract risk discussion aside for a moment and really get into these two specific companies the sources champion.
Right, the ones they say have more potential than any cryptocurrency precisely because they generate these gobs of cash flow. Alphabet first.
Let's do it. But hang on. Before Alphabet, let's just double-click on this foundational flaw idea for a second. Not just that crypto lacks cash flow, but what that means practically for an investor.
Good point. Because we said Bitcoin's done incredibly well, right? High risk, high reward, absolutely paid off for some.
So the question is, if I'm chasing those huge returns, why should I care about cash flow? Isn't the potential reward worth the risk, even if it's pure speculation?
That's the gambler's logic, maybe. But the sources argue cash flow provides something crucial. Resilience, like a survival premium.
Okay, resilience. How?
Well, let's break down that risk again. A crypto asset with no internal cash generation is totally dependent on money flowing in from the outside from other buyers.
So if the market sentiment sours, or maybe there's a regulatory crackdown?
The buying pressure dries up. And there's
Right.
There's no internal engine keeping the thing afloat. The price can just keep falling until people decide to buy again. It's built purely on belief, really.
The risk isn't just volatility, it's existential, almost. It could theoretically go to zero if everyone loses faith.
Exactly.
Yeah.
Now, contrast that with a business like Alphabet. It's got that anchor cash flows. So let's say the market tanks, sentiment turns really negative.
Yeah.
What happens?
Well, Alphabet is still running Google search, YouTube ads are still playing, cloud clients are still paying their bills.
Right. It's still generating billions in actual profit. And that cash flow, that profit, gives it options.
Options like paying down debt, continuing to invest in R&D even when money's tight elsewhere, buying back its own stock.
All the above. It's internal life support. The company can fund itself through the storm. It doesn't have to go cap in hand to the market for survival.
Okay, I see. It's like having your own well versus just hoping for rain.
That's a great analogy. It's that fundamental difference in self-sufficiency that leads our sources to put more faith in these cash-generating giants for the long haul.
That really clarifies the framework. Okay, now let's apply it. Let's dive into Alphabet, because the scale of cash we're talking about here is, well, it's almost hard to comprehend. All right, section 2. Alphabet. GOOG. The AI cash machine, as the sources seem to frame it, and the scale. It's just mind-boggling. A tech conglomerate, market cap around, what, $3.1 trillion?
Yeah, give or take, it's one of the biggest companies on the planet. And that valuation isn't just smoke and mirrors. It reflects this incredibly deep business portfolio.
It's not just Google search anymore, is it?
Oh, not for a long time. You've got search, obviously still huge, YouTube, massive, Google Cloud, growing fast, and then the other bets, the moonshots like Waymo and self-driving cars. It's a whole ecosystem.
And right now, the big story swirling around tech, especially companies like Alphabet, is AI. But often it's framed as a threat, right? Like generative AI could disrupt Google search, their main moneymaker.
That's definitely a narrative you hear a lot. But the sources we're looking at push back hard on that. They argue Alphabet isn't just going to survive the AI revolution. They're actually the single best positioned company to win because of it.
Okay, strong claim. What's backing that up? They mentioned specific advantages.
Two huge ones, really. Things competitors can't just buy or replicate quickly. First, the obvious one, data. The user data mode.
Billions of people using their stuff every day. Search, Maps, Android, YouTube, Gmail.
Exactly. Every click, every search query, every video watched, every route plan that's real world, constantly updating data. And it's incredibly diverse data, too.
Which is exactly what you need to train powerful AI models like Gemini.
Precisely. You can't just scrape the web and get the same quality or scale. This data is proprietary, it's dynamic, it's massive. It's like, if data's the new oil, Alphabet owns the biggest, richest, most active oil fields.
And rivals can't just license that level of data access easily.
Nope. It gives them a fundamental, defensible edge in training better, more capable AI. That's advantage number one.
Okay, what's number 2? Something more technical, right? Hardware.
Yeah, this one's super interesting. Their proprietary hardware, specifically the Tensor Processing Unit, the TPU.
Right. I've heard of TPUs. They develop their own chips instead of just buying from, say, NVIDIA like everyone else.
They did, and they've been working on it for like a decade. It shows incredible foresight. Think about it. Relying on off-the-shelf GPUs from someone like NVIDIA is fine. They're powerful general-purpose tools.
Like putting a standard V8 engine in your car, as you said.
Kind of like that. Good for lots of things, but maybe not perfectly optimized for one specific super demanding task. Building the TPU is like designing a specialized Formula One engine just for the math involved in AI and machine learning.
So because it's custom built for AI workloads.
It lets Alphabet run more AI calculations faster and probably using less energy than competitors using standard chips for the same tasks. It means lower operating costs for things like Gemini, and they can iterate and improve their AI faster.
Wow. So it's the data and the custom-built machine processing that data. That's a powerful combination.
It really is. And you can see this power translating into the financials already.
Yeah, let's look at the numbers. Even Google Search, the old part of the business.
Still chugging along just fine, as the source puts it. Revenue up 12% year over year last quarter. That's $54 billion from search alone in one quarter.
Incredible. But the growth in newer areas is also strong.
Definitely. Subscription revenue, that bucket, includes things like YouTube Premium, Google One, and also revenue tied to Gemini that was up 20% year over year, hit $11.2 billion.
So the core business is funding the growth in the next-gen AI stuff.
Exactly. And this brings us right back to that core theme, the cash flow engine. This is where Alphabet's financial power just dwarfs comparison to, say, speculative assets.
Okay, lay the big number on us. Free cash flow.
Over the last 12 months, $67 billion. 67B in FCF.
And FCF, just to remind everyone, is the cash left over after all the bills are paid and after the money needed just to maintain the current business is spent. It's pure profit available for other things.
It's the gold standard metric. But here's the kicker. The really stunning part, the sources highlight.
Go on.
They generated that $67 billion in FCF while also spending a record amount on capital expenditures, CapEx, building for the future.
How much CapEx?
Over the same 12 months. Also $67 billion. They basically matched their free cash flow generation with investment spending, mostly on expanding their data centers globally.
Wait, so they spent $67 billion building stuff and still had $67 billion left over in free cash.
That's the power. And it gets better. Their plan for 2025, they're projecting CapEx of maybe $75 billion.
$75 billion. Just on building infrastructure. That's
Right.
that's more than the entire GDP of some countries.
It's an almost unimaginable amount of investment. And crucially, they're funding it all internally from their own profits.
Which makes the comparison to OpenAI pretty stark, doesn't it? The sources mention that.
Okay. Yeah, OpenAI, the AI darling right now. Hugely innovative, but they've reportedly never generated positive cash flow. They rely entirely on outside investment, like from Microsoft, to fund their growth and compute costs.
Whereas Alphabet is building its AI future using its own money generated by its current businesses.
Precisely. That self-funding capability, that ability to generate massive FCF while making these enormous bets on the future, that's why the sources argue Alphabet is arguably the best, maybe even the safest long-term AI play. It controls its own destiny financially.
And with that financial strength, what else are they doing? Returning cash to shareholders.
Oh yeah, big time. They're using a significant chunk of that cash for share buybacks, consistently retiring shares outstanding.
Which means each remaining share represents a slightly bigger piece of the company, boosting earnings per share over time.
Exactly. It's a direct way to return value and compound returns for long-term investors, funded by that incredible cash flow engine.
And just quickly, their efficiency looks good too. Gross margin.
Very strong, especially for a company with such huge infrastructure costs, around 58.92%. That means for every dollar of revenue, they keep almost 59 cents before covering operating expenses like R&D and sales.
That high margin provides a big cushion.
A huge cushion. It helps fund that massive CapEx and the buybacks. It's just a sign of a really healthy, dominant business.
Okay, that's Alphabet, a complex beast, but the cash flow story is undeniable. Now let's switch to something simpler. Airbnb. All right, section 3. Airbnb, ticker ABNB. Market cap significantly smaller, around $77 billion. The sources called this one a much simpler story for investors. Why simpler?
Well, simpler in its focus, I think. Unlike Alphabet juggling search, cloud, AI, Waymo, Airbnb is laser-focused on one thing, providing a platform for unique home sharing and experiences.
People traveling, people renting out their places. Pretty straightforward.
Exactly. The core business is connecting hosts and guests. Now, the sources do mention AI could help them, maybe improve search results or matching people better, but that's seen as more of a secondary benefit.
So what's the main growth driver, then, according to the sources?
Geographic expansion. It's all about growing the network in new places.
Getting more hosts to list properties in more countries.
And getting more travelers to book stays in those countries. It's a classic network effect play. But it's not just about planting a flag, it's about doing it smartly.
They mention localization.
Yeah.
What does that mean in practice?
It means really tailoring the platform and the marketing to fit the local culture and regulations. It's not just translating the website.
Give me an example.
Okay, like in Japan, maybe they needed to adjust how listings are presented to meet specific cultural expectations about space or amenities, or integrate with local payment systems everyone uses there, or maybe address specific safety concerns hosts or guests might have in that market.
So really adapting the product, not just the language.
Right. And the sources say this strategy is working. They specifically called out seeing faster booking growth in places like Japan and Germany recently because of these tailored localization efforts.
Interesting. And there's still a lot of room to run with this strategy.
Apparently so. The sources note that even now, a huge chunk of Airbnb's business comes from just a few core countries. Think US, UK, France.
Which
Which means huge potential growth lies in getting deeper into other major travel markets where their penetration might be lower today.
Yeah.
They mentioned targeting places like Japan, Mexico, areas with tons of tourism but maybe less Airbnb density compared to, say, Paris or London.
So successfully localizing and growing in those new regions is key to their future growth story.
That's the narrative, bringing on more hosts and more guests in these expansion markets.
Okay, let's look at the numbers the strategy is producing. Gross booking value, the total amount spent on the platform, is huge.
Yeah, $23.5 billion in GBV last quarter alone. That's a lot of travel being booked.
And how does that translate into revenue for Airbnb itself?
Over the last 12 months, revenue was $11.6 billion. That grew 13% year over year in the last quarter, which is solid. But look at the longer-term picture. Revenue's up 243% over the last 5 years.
Wow, 243%. That really shows how quickly they've scaled up and become a major player.
Absolutely. It shows incredibly rapid adoption globally. And importantly, they've reached financial maturity fast. They're not just growing, they're profitable and generating cash.
Which brings us back to the core theme again, free cash flow. How does Airbnb stack up?
Pretty impressively, for its size and relative youth as a public company, they generated $4.3 billion in free cash flow over the last 12 months.
Now, $4.3 billion isn't Alphabet's $67 billion, obviously.
No, but relative to its $77 billion market cap, that's a very high FCF yield. It shows incredible efficiency. And a big reason for that efficiency is their business model.
The asset-light model, right. They don't own the hotels or the properties themselves.
Exactly. They provide the platform, the marketplace. We host provide the expensive part, the real estate. This keeps Airbnb's own costs incredibly low.
And that shows up in their margins.
Massively. We were impressed with Alphabet's gross margin near 59%. Airbnb's. Try 72.06%.
72%. That's really high.
It's phenomenal. It reflects how little it costs them directly to facilitate each booking once the platform is built. Most of the value booked flows through to become potential profit. It's the beauty of a successful platform business.
Okay, so they're making a lot of cash efficiently. What are they doing with it? Same playbook as Alphabet?
Pretty much the same discipline, yeah. They're using that $4.3 billion in FCF to, again, consistently buy back their own shares.
Retiring shares, shrinking the float, boosting EPS for the remaining shareholders.
Exactly. It shows a clear focus on returning capital and enhancing shareholder value directly from the cash the business generates. Strong internal cash generation, funding their own growth, and returning the excess to owners. It fits the source's thesis perfectly.
Right. So you have this focused, high-margin, cash-generating business with a clear growth path through expansion, actively returning capital. Again, a stark contrast to just holding an asset hoping its price goes up based on market sentiment alone.
Okay, so let's pull this all together. Synthesis and final takeaway time. We've looked deep into two very different companies, right? Alphabet, this massive, complex AI and tech giant. Airbnb, a much more focused travel platform.
Many different businesses, yeah. But they share that one absolutely critical trait, the one that connects back directly to the critique of crypto we started with.
And the conclusion from the sources seems pretty clear-cut, doesn't it?
It really does. When you actually look under the hood at the financials, the argument is that companies like Alphabet and Airbnb are just fundamentally better, safer long-term investments than speculating on crypto assets that don't generate their own cash.
It boils down to that free cash flow. That's the magic ingredient here.
It really is the power source. We saw Alphabet with $67 billion in FCF, Airbnb with a super efficient $4.3 billion over the last year. And that cash lets them do two crucial things that, a Bitcoin or an Ether token just can't do.
Exactly. First, they can plow money back into the business to fuel future growth. Alphabet's data centers are the perfect example. They're building their future success.
And second,
they can directly return excess capital to the owners, the shareholders, through those buybacks, actively increasing the value of each remaining share.
crypto assets.
Yeah.
They just sit there, right? You hold them or you sell them. They don't reinvest in themselves or actively reduce their supply to benefit holders.
Right. They lack that internal economic engine. So Alphabet and Airbnb look like healthy, self-sustaining organisms, economically speaking. Crypto, in this framework, relies entirely on external factors, namely more buyers showing up.
Which leads nicely into that final provocative thought the sources left us with. It's about comparing beliefs, really.
Yeah, think about it. If a crypto asset's value depends entirely on belief, the belief that someone else will value it more later.
How does that compare to the action Alphabet is taking?
Specifically, that planned $75 billion spend on data centers in 2025.
That's not just spending money. That's a massive tangible bet on their own future, isn't it?
It's a profound signal of their belief. They are investing billions, generated internally, because they are fundamentally convinced that the world will need their AI services, their infrastructure, even more in the future. They're building the utility.
So the closing question for you, the listener, is this. Which signals stronger conviction in future value? An asset waiting for demand to appear?
Or a company actively spending $75 billion of its own cash to build the infrastructure designed to meet that future demand? It really makes you think about where true sustainable value comes from.
Definitely something to chew on as you think about your own long-term investments. Thanks for joining us on this deep dive comparing cash flow kings to crypto contenders.